All right, people. In this practice, we're going to create capital allocation line, efficient frontier, and also indifference curve. So it always comes from the risky portfolio. In this very simple case, so we have a risky portfolio. All right, and the risky portfolio is made only two assets, bond and stock. Okay, so you have a bond, you have a stock to make up the risky portfolio. And you also have the risk-free assets, and the risk-free assets basically is the T-bill. All right, so they all have certain risk and return characteristics. So for the returns, the bond gives 8% on average, and for stock 13%, and for the T-bills that's a 5%. And for the risk level, okay, you have a 12% standard deviation for bond, 20% standard deviation for stock, and for T-bill that's 0% because it's risk-free. That means no variation of the bond return. Okay, it's a T-bills, so that's also a debt obligation just issued by the U.S. government. Okay, and you can also get the covariance and call relation. So I would give you the correlation as a 0.3. So based on the correlation, you can calculate the covariance, which is the bond risk times the stock risk times the correlation. All right. And what about the correlation between stock and the T-bills? That's 0 because there's no risk associated with the T-bills, so the correlation between the two is 0. And the correlation between bond and T-bill is also 0. Okay, so let me just merge the cell, okay, and put some border here. All right. Okay, so now I'm going to create a portfolio. So I will use a weight of bond and then weight of stock. Okay, so I can just put negative weight on my stock. So negative weight on the stock basically means I'm short selling the stock. So I just put a negative 50% right here. Oops, negative 50% right here, and I want it to change by 5% increment. So from negative 50 to negative 45 all the way to 150. Okay, it can be 150 because I can trade on margin, so I can buy more stocks than the money I have from my own pocket. All right, and for the bond, the weight is just 1 minus whatever the weight of stock is. So if you have a negative 50% for the stock weight, so that means you short sell the stock and you have some cash, use the cash to buy more bond. So instead of getting 100% of your money in bond, you have 150% of your money invest in bond. All right, so you can see that the weights are always add up to 100%. Okay, and then I need you to calculate the risk of portfolio. Okay, just put it as a portfolio risk. And also, I can get you the return of the portfolio. Okay, the return will be pretty easy. So you just use the weight of bond times the return of the bond. Make sure you lock that, and then you use the weight of a stock times the return of the stock and lock the returns. Okay, and for the portfolio risk is a different animal. You're going to use a square root, and that's the formula you need to follow. So the square root of weight of bond squared times the risk of the bond squared plus weight of a stock squared times the risk of a stock squared, okay, plus 2 times weight of a bond times weight of stock times risk of a bond times risk of a stock times the correlation. All right, before you close it, you need to make sure these cells are locked, like the risk of a bond, risk of a stock, and risk of bond stock, and also the correlation. Okay, so this is also measured in percentage. Okay, changing the format a little bit. Okay, and then I'm going to double click. You will see that I have all this generated. Okay, and then I can calculate the Sharpe ratio. The Sharpe ratio is the is the return minus the risk-free rate, which is the T-bill rate. Okay, you lock it and you put a parenthesis here. Yeah, this called the risk premium of the portfolio divided by the risk of the portfolio to get a Sharpe ratio, and it is supposed to be a number. Okay, just change the format, do not use a percentage, and then just drag it all the way down. So in your observation, where you get the highest Sharpe ratio, I think it is somewhere right here. Okay, so when you have a 40% in bond and 60% of your assets in stock, then you will have the highest Sharpe ratio at 0.4226. Okay. All right. So what you can do here is to get a chart. So you're gonna insert, and you want to choose this scatter chart, and you want to do the scatter chart with this curve. Okay, and markers. All right, so I want you guys to right click on the select data and add the series. The name is efficient frontier, and the x values would be the risks. Okay, and the y values would be the returns. Okay, so this is the efficient frontier you would have. So you can see somewhere the risk could be the minimized. So you could, I think, if you just put more digits here, you can see the risk can be minimized at this place. All right, so I'm talking about this data point is right here. See my mouse? It's right here, and the highest Sharpe ratio is when your risk is at 14% and your return is at 11%. Okay, that's when you get the highest Sharpe ratio, but we're gonna worry about that later. Okay, for now this is your efficient frontier, and we can see right here is when your risk is lowest, but that may not be your best choice because you want to make your financial decision based on the Sharpe ratio, which incorporate the risk and return both. Alrighty, so you can just copy this whole thing. Okay, Control C, copy it, and then Control V, paste it. Okay, and you can make the weights here as well for the weight of a stock, weight of a bond, portfolio risk, and portfolio return. We're gonna do some maximization work here. So you can start the weight of stock as 50% and weight of bond is 50%, and then you can see the calculations are performed automatically, and you can just perform solver. So you go to data, you do solver, and your goal here is to maximize the Sharpe ratio. Click the Sharpe ratio, maximize it by changing the weight of a stock. Okay, by changing the weight of stock. There is no constraint need to be added in there, and if you hit solve, then you will see this is your result. So it's telling you that when the stock and bonds are allocated on a 40-60% basis, then the Sharpe ratio will be maximized at 0.4226, and I will call this the optimal risky portfolio. So the optimal risky portfolio is the one you have the highest Sharpe. Okay, so I'm just putting notes here, highest Sharpe. Okay, and you can also do this. So you can have the risk-free assets. You can have the risk-free assets, and in the risk-free assets category, so you have the return. It's 0%. It's a 5%. Just to borrow it, 5% from here, and the risk is 0%. Okay. All right, and you can draw the capital allocation line. All right. The thing is, you need to do it on the same chart. So I want you guys to right-click on this chart, select data, and I want you to add a series, and this is called a capital, let's say market line. Okay, capital market line. It can be called a capital allocation line in a very narrow definition, but if you are dealing with the entire markets, then it's called a capital market line. So the X value here would be the risks, and the Y value here would be the returns. Okay, so after I hit that, you will see I have developed a straight line, okay, that is tangent with the efficient frontier. The efficient frontier basically is all the investment options for you. So you can put all kind of ways of a stock, short sell it, or doing margin trading, and you will put the rest of your money in bonds, and you will get all kinds of a risk and return combination for your portfolio. So you can choose to have a lowest risk portfolio, or have the portfolio with the highest Sharpe ratio. And the Sharpe ratio is the slope of the line from this risk-free rate all the way to your investment. So right here at this particular point, okay, this particular point is your optimal risky portfolio. That's when the Sharpe ratio is the highest. If I draw another line, okay, let me just draw a line here. Okay, so I draw a line here from the risk-free rate all the way to here. I wouldn't call it a good investment choice for you, because this is completely unavailable. This line is unavailable because none of your investment could give a point, can have a intercept with this line, because this line is above the efficient frontier. And if the line is right here, okay, it would cut the efficient frontier right here, then this is where your investment is. Okay, you're going to have an investment here. But at this point, you wouldn't have the best option, because your Sharpe ratio is not maximized. Once again, the Sharpe ratio is the line from the risk-free rate to wherever your investment is. So right here, this is the slope of this line is the Sharpe ratio, and that is a flatter line, so the Sharpe ratio is lower than this orange line, the one with a higher slope. Okay, so if I do it here, the Sharpe ratio is still lower because the slope is still lower. If I do it here, it's getting close, but I can't go higher than that because it will not be available by these investment options. So it has to be keep going up, up, up. So the situation is getting better in terms of risk-return combination until I reach right here. Okay, so that's just an illustration of a Sharpe ratio. A Sharpe ratio, once again, is a slope of the line drawing from here, the risk-free rate, to wherever your investment is. You can invest right here, you can invest right here, you can invest on this dot right here, but the best of your investment is right here, as indicated by the orange line, because at that place, your Sharpe ratio is maximized. You reach the best risk and return combination. Okay. The next thing I want you guys to do is to get the capital allocation line, even though it's the same as the capital market line we did, but I just want to show you that the capital market allocation line is a little different. Okay, so it's based on all kinds of investors in this market. So these investors are different. in respect of a risk aversion. So you have the risk aversion factor, okay, 4, 5, 6, 7, 8, all right, and I can just put a very large one, 100, okay, and you also have their utilities, okay, and you also have the risk level, you also have the return level for these individuals, and for all of them they have two choices. They can either invest in the optimal risky portfolio, or they just invest in risk-free. Okay, so ORP stands for optimal risky portfolio, okay, and risk-free. So I just start with a 50-50%, that kind of combination, and then drag it all the way down, and you can see that if the aversion indicator is lower, then this person is less risk averse. If aversion goes higher, then this person is more risk averse. So that means for the same amount of risk, this person is going to be a more risk averse person is going to be less happy. All right. So for the risk level, for all of them, you're gonna use the portfolio risk up here, lock it, multiplied by the weight of the portfolio. Okay. And I need to use the format painter to keep the format consistent. And for the return, it is going to be the portfolio return times the portfolio weight plus the portfolio, the risk-free return times the risk-free weight. Okay. So let me just decrease the decimal here. Okay, and this time I don't want to name it as portfolio risk, just call it risk and return, because truly I have two assets here, and they're not just a risky portfolio. Okay, so I can remove the name here, do a cut and paste. So these are the names. Okay, these are the names and these are the titles. Okay. All right, and before I drag it down, I want to make sure the portfolio return and the risk-free return are locked. Okay, so this is locked. This is locked as well, and then I just drag it down. And for the utility function, and for this one, for the weights, I know it looks a little funny, so let me just put a 50% for all of them. Okay, just put a 50% for all of them instead of just dragging them all the way down. Okay, so 50-50, but make sure the weight of a risk-free is 1 minus the weight of optimal risky portfolio. Okay, to get the utility, then you would need to incorporate the return as the first factor minus half of the aversion indicator, okay, times the risk squared. Okay, and you want to make it a number. Okay, make it a number. All right, you can see that for this extremely risk-averse people, that's not good enough, and for this person, because for the extremely risk-averse person, the utility is negative, so that's not good for this person. But I can put a 0 here to see whether this person is a little happier. Yes. So if this person has a 0 risk aversion, then the utility would be would be higher. Okay, and that means this person is happier. So let me just do solver multiple times, but it's not going to take me too long because each time I want to maximize the utility, okay, by changing the weight of a risky portfolio, which would lead to the change of the weight of a risk-free, and that's going to change the risk and the return of that investor. So you have different investors, they have a different risk aversion. Okay, they have different risk aversion, and they all invest in two assets, the risky and the risk-free. So if they invest in the risky, it's 100% risky, then they would be here. That line, it will be right here. It's the intercept between the capital market line and efficient frontier. So if they invest 100% of the money on the risky portfolio on stock and bonds and no risk-free assets at all. So right here is when you have no risk-free assets at all. Okay, and let's see. We are going to perform solver, data, solver, and the first one is to maximize the first investor's utility by changing the weights. Okay, hit solve. All right, now you can see it generate the result as 74.4% and 25.6%. Okay, and then I'm gonna do it again. Data, solver. This time I want to maximize the second investor's utility by changing his or her investment in the risky. Okay, solve. Okay, you see for different risk aversions, different kind of risk preference would indicate different combination of risky and risk-free. And then I'm gonna do it again. Maximize this utility by changing this weight. Solve. Okay, and then I'm going to do the solver again, changing this utility by changing this weight. Okay, and then solve again. So change this utility by changing this weight. Solve, and then solve again. Change this utility by changing this weight. Ooh, that is so high. Okay, this is so high. You can see that it's getting so crazy, but it does not matter. It does not matter. So that basically means that this person is investing so much, borrowing so much money to play with the risk. So let me just put it as a 0.2, a more realistic number. Okay, so let me perform solver again. Okay, now we're talking. Okay, still the number is kind of big, and I don't want it to be that big, so just put 1 here. Okay, and then solver again. Solve. Okay, maybe 3. Do it. Solve. Okay, 3 is 2. Still is not the one I wanted, so let me do 2. Okay, and I will show you my point. So if I do it 2, save solver, I didn't change anything. Yeah, so you can see for the least risk averse person, but this person is still risk averse, but it's just the least risk averse among all 6 of the investors. You can see this person gonna put over 100% of his money in risky portfolio and negative weights in risk-free. That means they are borrowing money to invest in the risky. They are borrowing risk-free money to invest in the risky. Okay, and then I'm going to allocate all this data. Okay, so I will right-click and then select data, and then this time I will add capital allocation line, and the X values would be all the risks, and the Y value would be all the returns. Okay, as you can see, the gray dot basically is it is the capital allocation line, which is the best allocation for all kinds of investors, and they all want to maximize their utility, and which means they all need to have the highest Sharpe ratio. Okay, so the difference is they all are at different points. So right here, this is investor 6. Okay, this gray dot is from investor 6 when the risk aversion is the lowest. And this person is actually borrowing money, because you can see this person is beyond the 100% risky portfolio, and this person is investing in 149% of its money in the risky portfolio. So that means this person is borrowing money. This person is trading on margin. And for all the other investors here, and here, they all have a high risk aversion, so they just don't put all of their money in the risky. They put some money in the risky and the rest of the money in the risk-free. The more risk averse they are, like for investor 5, the risk aversion is 8, so they would be closer to the risk-free assets. So that means they would get less risky and more risk-free. So you can see that their return will be lower. This dot has a lower return compared to all the other dots along the gray curve, and this dot also have the lowest risk compared to all the other dots indicated by other investors. Okay, so let me just double click on this chart, and I want to do a quick layout. Okay, so I want to do layout 1. So layout 1 is basically showing me all of the legends. So I want the legends to be down the bottom. Okay, and the axis title for the y-axis, the vertical axis, I want it to be return, and for the x-axis I want to be risk. And I don't need the title here because my legend already tell me what they are. Okay, now it's good. All right, and then I want you guys to do another thing for a particular investor, and this investor is called A4. All right, because this person's risk aversion is equals to 4. So let's say investor A equals to 4. And then for this investor, I want you to get the return and risk and utility, okay, and the weight in optimal risky portfolio. Optimal means the Sharpe ratio is maximized. Okay, and let's see, this person's weight can be from -40%. That means they just short the risky portfolio to -20%, and then I put it all the way, to 160%. Yes, the chart is on the way, so I'm going to move it down. Okay, so right here, that means this investor A4 is borrowing money to invest more in the optimal risk. And right here, the investor is short selling the stocks and bonds and short selling the risky portfolio. Okay, and then we need to calculate the utility of this person. Number one, you need to know if that's happening, then what's the return for this investor. Okay, and we're doing this utility indifferent formula, and we're assuming the utility is the same no matter what kind of investment we're doing. We can put a negative weight in the risky, or we put a more than 100% weight in risky. We always want to have the same utility. So let me just put a random number for utility as a 0.1, okay, and then just make all the numbers below it equals to the previous one. So what I'm doing here is I want the utility to be constant. So if I change to 0.06, then they all change in the same pace. Okay. And for the risk basically is the weight of the portfolio times the risk of the portfolio. We went over that. Actually, it's supposed to be a very complicated formula. But because there's a zero correlation with the risk-free and the risky portfolio, so all the other components are eliminated. Okay. So decrease the decimal. and then just duplicate the stuff. And the return, well, the return will take the formula. This time it is not the weight of the risky times return risky plus weight of risk free times return risk free. It is taking a formula. So it is the utility, same utility, okay, plus 0.5 half, which is half times 4. 4 is the adverse indicator here, times the risk squared. Oops. The risk squared. Okay. And then I'm going to drag it all the way down. Okay. As you can see, for each level of risk, it comes with a certain return. And that's for the individual investor. He has his risk aversion equals to 4, and I'm going to create the utility indifference curve. And on this curve, all points would indicate the same utility. So I'm going to right-click on the chart, select data, and I want to add a series, and the series name is this, utility indifference curve. Maybe not. Utility indifference curve, and I want to mark A equals to 4. All right, and I want to edit that. So the risk would be, the X value would be the risk. The Y value would be the returns. Okay, and then hit OK. All right, so you can see this is the indifference curve when my utility equals to, when the aversion equals to 4. Okay, and I have the same utility across different kind of investment combinations. All right, they are all equal to the same number utility, but you can see I will not be able to get this high utility because the existing investment does not allow me. You see, no matter how I play with this risk-free assets and the risky portfolio, they cannot reach a utility curve that is that high. All right, let me zoom out a little bit. And if I change the utility to 0.0 to 0.2, then you can see the curve is even higher, and that means this curve means I'm even happier. But it's not possibly reached by this risk-free assets and risky assets together, and it's just not available. Okay, so that utility cannot be reached, even though it makes me pretty happy by having this high, either high return, high risk, or low return, low risk, but it's just not available. So if I make the utility lower down to 0.06, and now we're talking. Okay, we're talking. So you can see right here, there are two possible solutions for me to get this utility of 0.06. It's either right here when the utility curve has a intercept with the efficient frontier. That means when I'm investing all of my money here in the stock and bond, and right here I'm investing more in the stock and less in the bond. As you can see, the risk is higher here. Okay, risk is higher towards the stock. So right here, I invest all my money in risky portfolio, and in this risky portfolio, I invest more in stock and less in bond. Or I can have the same utility by doing a low risk, low return combination. Okay, this is a high risk, high return combination. Right here, when the yellow curve cut the capital market line, you can see that's the low risk, low return combination. That basically requires me to put a lot of money in the risk-free assets, but not all of them. I also need to allocate a little bit on the risky portfolio, but not too much. Okay, so that's where it is. But still, you can see I can do better than that. I can be happier. So if I do this utility, I change it to 0.065, then you see my utility curve got moved up a little bit. That means I'm happier, 0.07. Then I'm happier and happier. So what will be the highest? So I can't do 0.2 because that's too high, and that's not even available by investing in this market, risk-free or stock and bonds. This utility cannot be reached. So I'm going to borrow the number here. I can see that my maximized utility based on the solver is this number. Okay, so I will just use 0.0723 as my utility, and you can see at this place my utility curve is the highest. Okay, that means I can reach higher return and have a lower risk. So that's a higher utility. Okay, and it's also reachable by the existing investment tools like risk-free. So that means my point is right here. This is a tangent point. This is a equals to 4. That's the tangent point. So let me just put here. So that's a equals to 4. So the return here is 10.6%. Okay. Okay, so this is the tangent point. All right, and all other people, they have their indifference curve. I can do another one for practice purpose. Let's say for investor A equals to 2. Okay, let's say for this guy A equals to 2, and for the curve it equals to 2, and I'm going to use the same return and risk. So the risk is determined by the portfolio risk and the weight of the portfolio. Okay, the risky portfolio, of course, and I just need to get the return and the utility. Okay, return and the utility. Okay, so for now, let me put the utility as 0.06 or 0.1. It's the same. Okay, and all the cells will be the previous one, and then I drag it all the way down. All right, and for the return, it's a function of utility. Okay, it's a utility plus 0.5 times 2. This time my risk aversion is 2 times the risk to the power of 2. Okay, so these are all my return function. Okay. Okay, and then I'm going to put the indifference curve here. Okay, so I'm going to insert, right click on the chart, and then I'm going to add another series, and the name of it is utility indifference curve A equals to 2. The x values would be all the risks, the same risks, and the y value would be all the returns for this individual. Okay, so hit OK. All right, as you can see, this is the guy I'm looking at. So when A equals to 2, he or she has a quite different utility curve, and I can make it a little. I can extend this curve a little bit. As you can see, for A equals to 2, the curve will cut the capital allocation line right here. But you see, this utility is still too high, right? It's still too high. If I put it as a 0.2, it's even higher. It's more unrealistic. It's more unrealistic because I cannot for A2. This person, that person cannot reach such high utility. Okay, and if I put it as a 0.05, and you can see this indifference curve is it's just too low. It's just too low. It's not the best we can get. So I can just borrow the maximized utility for this individual. Okay, it's right here. That's a 0.0946 for the individual with aversion equals to 2. You see A equals to 2 right here. That's investor 6. Okay, and then I just to here, you will see that for this individual with aversion equals to 2, it cuts the capital allocation line right here at this dot. Okay, at this dot. So that means at that point, this investor has the highest utility. This person is the happiest, and that's for a less risk-averse individual or a more risk-loving individual. This person prefers to invest more of its money in risky portfolio, and he's going to trade on margin by borrowing at risk-free rate to invest more.